So I hope you are doing well and you are learning and in your paper, and I hope the papers you've written already have gone well, and still expecting the best from you. As we always do, I will guide you, I will teach you what you are supposed to know, what you are supposed to do, so that when you go to the exam, so you know you found one thing. So if you listen to our advice and our guidance, you go there, you definitely succeed, because it was the same thing we did. Now, tonight, my agenda is to do a quick summary of the questions we've looked at so far in the business finance, and also do some small additions to it, some questions we were unable to solve. So that is just my agenda for tonight, and to fully prepare you for the exams. That notwithstanding, I have already solved a comprehensive question with some of you already via Zoom, and I've uploaded it over here. Today, our agenda is to finish up that question and finalize everything. So we start off by looking at this particular question, which I have uploaded it already, and I hope some of you have already watched it. So we looked at the theoretical aspect of the question. What is risk? What are the basic components of risk? Explain the difference between business risk and then market risk. So I'm going to add one, which says that sequentially enumerates the risk management process. So you should know the steps involved when we come to risk management process. And you have established the context, identify the risk, you analyze the risk, you evaluate the risk, you treat the risk, then you monitor and review, then finally communicate the results. So we have about 8 steps in the risk management process. Establish the context, identify, analyze, evaluate, you treat, you monitor and review, and you communicate the results. These are the steps involved in risk management process. So in addition to these theories, add this one to it. Now question D, I think we've solved it already. You know the formula is Ri is equal to Rf plus beta bracket open Rm minus Rf. I think this is what I'm trying to talk about. So we did it already. This is it. And in that question, you were asked to find the market risk premium. And we know market risk premium is our market risk minus the risk free. In this question, you were not given the market risk. So you have to find the market risk, which we did over here. So in an attempt to find the market risk, you do change your subjects. So you find your market risk, and then you fix in your market risk into the market risk premium formula. Sorry, here. Into the market risk premium formula to determine the market risk premium. So that is what we did for the very first question. Then Anchor Limited, you were supposed to find the expected return and then the beta. And with this question, you were not given the weight, so you find the weight. So what did we do? We found the weight by dividing each of them, finding the total investment value, dividing each of them by the total to get the weight. So we found the weight. We use that to find our expected return, and then we found our beta. So, oh wow, there it is. The question I was just talking about, the steps in risk management process. So this is for the second calculation over there. And then you move on to the steps in the risk management process. Then what is a derivative and who are the players on the derivative market? Derivatives are investment variables that derive their values from other investment variables. And the players on the derivative market, we have hedgers, arbitrageurs. Let me see here. Derivatives are financial products that derive their values from other financial products. Example, options, futures, swaps, basket, forward. And the players on the derivative market are hedgers. We have speculators. And then we have arbitrageurs. Hedgers, they take two positions. They do sell and buy. Speculators, they forecast the market. And then arbitrageurs, they are like the opportunists. They are there to cash in on the lapses in the market. Then we went on to the next question. Question 2, which is broadly on portfolio. You have the S&P, and then you have the market index, GM market index, where you invested 30% in the S&P and then the rest in the GM market index. So I told you that when always portfolio weight is equal to 100% or is equal to 1. So if I've invested 30 in A, then you should know that 70 is in B. You don't need to wait for them to tell you. Don't go and raise up your hand in the exams hall and tell the invigilator there's something missing in the question. You don't know what you're doing. Once you have been given, there are 2 investments and you have been given 1 weight, you should know the other. If there are 5 investments and you have been given 4 of the weight, you should know the other. So if they say, I've invested 0.7 in A, you should know that 0.3 is in the other. You don't need to wait for them to tell you. And that is the genesis of the question. So 30% in S&P, with S&P having 9.93 expected return, and then GM having 8.2 expected return, with their respective risk or the standard deviation 16.21 and then 33.11. Given a covariance of 0.0050. Here, you must take note of the covariance. In past question, you are seeing 0.0050. You go to the exams hall tomorrow and then they've added 0.00050. Then you are there without taking notes. Then you saw it in the past question. Oh, we solved it like this. Then you are chewing and pouring figures. You get wrong answer. So you should take notes. So we came here and then we did justice to that question by finding our expected return. And trust me, make sure you put the formulas down and solve them systematically. Solve them systematically. You see the way I'm solving them systematically? I didn't just put the formula down, put it inside, and then put the answer there. I did a systematic work. So we solve it, find the expected return, we find the standard deviation, and then you interpret your standard deviation in that order. Then the next question on that paper, you were given investment expected returns and then their risk, and then you have to comment or which of them are you supposed to invest into. Given the risks and expected return, we look out for the covariance for decision making. So you find your covariance, which I just did here. So risk over expected return gives you the covariance. And the lower the covariance, the lower the risk. So if 9 people are standing here, 10 are standing here, and then I say 10 of you jump from the 3-story building. In fact, only one person will take the risk. So it is the norm that majority will go in for the investment with the lower risk. So you select the investment with the lower one, and then you give your comment as follows. I suppose the next question is on returns, and you were given a question and information where starting investment is 1,000. At the end of the investment, it is 900. So clearly speaking, you are having what you call capital loss, not a capital gain. And then dividend was 50. So therefore, the return is negative 50. And you are supposed to find a percentage return. And percentage return is equal to your CD return over the price at the beginning. So if we know our CD return is minus 50, then the minus 50 over the 1,000 should give us minus 5% as our CD return. There are some of the questions you don't even need to waste more than 30 seconds on it. The question you are going to write, under 1 hour 15 minutes, you should be able to wake up. You should be able to finish. When I say wake up, people will go and be flexing. So under 1 hour 15 minutes, you should be able to clear everything and make sure you go back again, punch the calculator, and be very sure of the figures you are putting down, because it is statistics you are doing, and because it entails a lot of figures and operational signs, minus, plus, multiplication, raised to the power, percentage, you might be missing something. Because it also involves 0 point something, 0.0, you might be missing something. So go back and go and check everything one by one and make sure you're okay. And don't rush. Take your time and put and present your information to avoid lots of mistakes. Now, the question 3. Say you have 2 stocks, amusement park and then the Sky Resort. And these they are following returns. These are returns over there. So if you invest, you have 100 Ghana cedis and you invest 50 in A and then 50 in B in S, given a covariance of negative 0.0148. What is the portfolio expected return and then your portfolio risk? And we know to find the weight, it is the 50 over 100. 50 over 100 give you weight of 0.5 for the 2. So 0.5 multiplied by 0.07, 0.5 multiplied by 0.09 gives you 0.08. That is 8%. Or you can go by this if you think you are okay with these formats too. 0.05 multiplied by 7. But don't go and say 5 multiplied by 7. You get it wrong here. In fact, you are going to get 70 if you do that. So I always prefer going by these formats because everything is in my 0 point for me. And then my standard deviation. Because the standard deviation here, I already did one here and did it in steps for you. When I got here, I did not waste any time. I just put the answer down straight. I did the expected return also here for you in steps. So go and do it in steps. As for me, I don't have any exams to write. I am teaching you to do. So you are supposed to do it and waste the time and do all those ones. So do it in steps. You are practicing. So do it in steps and go and score all the marks. When you go and do it like this, you lose the marks. It is right, but you are going to lose marks. Go look at it. When you come here and the marks allocated to this particular one is 3 marks, the answer takes 1 mark or half a mark, depending on how the marking scheme is being structured. So let me say this one take 1 mark. Then the steps here takes, let's say, half mark. And then when you get the formula correct, 1 mark. So 1, 2, 3. So just imagine you did not put the formula down. You have lost 1 mark. You place this one down, you get the half mark. You miss this one, you miss half mark. You get this one, you get 1 mark. So you are going to get 1.5. Or I decided to give half mark here, half mark here, half mark here, half mark here, and then 1 mark here. So you miss the formula half mark. You get this one, half mark. You miss this one, half mark. You miss this one, half mark. You get this one, 1 mark. So you are going to get 1.5. So you come out from the exam, so, oh, Charlie, your standard deviation are 24. This one to say 24. We all got 24. But one person followed the right way to get the 24. One person did not follow the right way to get the 24. So ebeba, ubeka say omi yeye. Na wenya D. Ebeba obi so yeye. Na wenya A plus and na wenya C. Na say but we can say me na me kire na ade. How say me nya D na ono nya A plus. These are some of the mistakes you do. So please go and do the writing. So the same interpretation goes on here. I'm not wasting much time because I know when you don't understand, you can pause the video and then you rewatch it again so that I'll not consume much of your data. So this is where we ended on the question 3. So I'll do the question 4 and then that of the B2. So I'm trying to repeat my question. So let's continue then. So you have the question given you over there. An investor received the following dollar returns on a stock invested 25 and then receive 1 cedi dividend and share price of 2 cedis. So share price has increased 2 cedis. So now looking at this particular illustration, you'll be able to know the variables you've been given. Is it question 4 or question 5? Question 4. So you should be able to know the variables you have been given. Now, the variables you have been given is the price at the beginning. which is 25. Price at the end. Price at the end. We have not been given. We don't know. But they give us the capital gain. Capital gain is also called the share price appreciation of 2 cedis. They've given us dividend of 1 cedi. And then the question said we should find the capital gain yield. Anytime we are talking about yield, we are basically talking about percentages. Now, capital gain yield is equal to what? The capital gain divided by the price at the beginning, all multiplied by 100. So, if you want to infer, then I'll say that my capital gain given me is 2 divided by the price at the beginning, 25, all multiplied by 100. It should give me the answer. I don't have my calculator here, so you will do all the calculations. So that will give me the answer. Then they said I should also find my dividend yield. So in fact, whatever you are going to get, the answer you are going to get here is going to be in percentage. So they say you should find your dividend yield. And dividend yield is equal to your dividend divided by the price at the beginning, all multiplied by 100. So dividend given me is 1 divided by 25, all multiplied by 100. And whatever I'm going to get is also going to be in percentage. Then they say I should find my total return in cedis. My total return in cedis is equal to dividend plus capital gain. And dividend plus capital gain. I know dividend is 1, capital gain is 2. So therefore, it is equal to 3 Ghana cedis. Then you have to find total return in percentage, right? And it's equal to my CD return over the price at the beginning or whatsoever. So I can decide D plus CG all divided by the price at the beginning times 100. So 3 divided by 25 now whatever you are going to get should also be in percentage. This question shouldn't take you more than 2 minutes to solve it. Then question 5, which all of you are expected to do. All of you are expected to solve. In fact, when you go to the exam hall and you did not tackle break-even, consider yourself failing, because if you cannot solve break-even and score all the 15 or 10 marks over there, then there is no question you can even solve and score everything. Common break-even. If you cannot do it and score it, then know that And I'm not saying go and chew and pour. No, you don't understand and do it. You go there and then you score anything. Now, when it comes to the break-even question, or you see break-even, we have several methods of dealing with it. You have the graphical approach, we have the equation approach, and then we have the contribution margin approach. Now, your syllabus wants you or enjoins you to use the contribution margin approach to do it. So if you've been asked find a break-even point in unit, then you start fixed cost over selling price minus variable cost per unit. You are done. It's wrong. So your syllabus wants you to use a procedure or a format in doing it. And the format in doing it is what you call the contribution margin approach. Contribution margin approach. Now, in an attempt to use the contribution margin approach, there are two things you are supposed to know. You needed to know your contribution margin and also know what you call your contribution margin ratio. Now, if you read the question, your question says that, let's go to the question. Abo Company Limited is a new cinema located in Junction Mall. The manager has made the following projections for the first year. Total fixed cost expense is 48,000. Total variable cost is 8 Ghana cedis, and cost per ticket is 12. These are all the variables you need to manipulate every question they are going to ask you. The fixed cost, variable cost per unit, and then the price. Now, let's put our variables down. So fixed cost is equal to 48,000. VCU is equal to 8. BX is equal to 12. Now, you find what you call the contribution margin. And contribution margin is given as your selling price. So let me put here, I know some people will go and selling price minus the VCU. So 12 minus 8 is equal to 4. So contribution margin is 4. Then find the CMR, the contribution margin ratio, is given as your contribution margin divided by the selling price. And so therefore, the 4 divided by the 12, which is 4 is about 30% of the 12. So 0.333333. So you convert it in this manner before you even go ahead and looking at the questions you've been asked. Now, I'll be doing the contribution margin, and then I'll also be explaining the equation via, I'll just be doing this oral explanation because that is not what we need to buy unless the question asks you to do that. Now, what were the questions being asked? Find the break-even points in units using the contribution margin approach. So, I break-even points in units. Or somebody say break-even points in quantity is equal to the fixed cost over the contribution margin. Note, anytime you've been asked anything about units, it is divided by contribution margin. That is, I'll say it once and I'll say it again. Whether you have been asked to find break-even point unit, profit level unit, whatever units, it is divided. The denominator is contribution margin. Anytime you've been asked anything in sales, the denominator is, or the denominator, whatever you call it, is the contribution margin ratio. So when you are finding units, the denominator should be the contribution margin. When you are finding ratio, the denominator should be what? The contribution margin ratio. That is your only savior over here. So fixed cost is 48,000 divided by contribution margin, because you are finding units, divided by 4. So your answer you are going to get should be something in units. The next question says what? You should find compute the break-even point in sales in CD. So break-even point in CD sales. So my CD sign. So let me just put a currency here, but the CD sales. So it's going to be the fixed cost divided by what? The contribution margin ratio. So 48,000 divided by 0.333. And the answer you are going to get should be something in cities. So should be something. These are very, very important. Your symbols, your CD sign, or your unit of measurement is very, very important. Now, the next question says, using the equation method, find the break-even point based on profit equation. These are the same words. Using the equation method. Now, using the equation method, so it is the profit. Let me see, is it profit level unit or? Okay, so you are finding the profit level units. So profits our profit level units is equal to the fixed cost plus the target profit, all divided by selling price minus variable cost per unit. This is equation method. So if this were to be contribution method, we would have just seen fixed cost over selling price minus variable cost per unit. That's all. So take note. So this is 48,000 divided by selling price is what? 12 minus 8. Then whatever you are going to get should be something in units. Now, so take notes. This one is equation method. This one is equation method. If it is contribution method, let me do it. I know some people. If it is contribution method, then we go like this. Over contribution margin. So this is for contribution method. So this particular one is for contribution method. What we did is the equation method. They wanted the equation method, so that is what will be my solution. If it is contribution, you go like this. So I told you anything unit. So this one I don't need a lot of rocket science. It's just following procedure. Anything unit, contribution margin. Anything sales, contribution margin ratio. Now let's go look at the next question. If Bio sets its operation income target at 30,000, oh sorry. Yep. Okay, this one is not target, so this one is not target profit. So this one is break even, same break even point in quantity here. So the answer you get here will be the same answer you get here. Good. So they are just tricking you. Look at it. Find the break-even unit using contribution margin approach. Using the equation method, find break-even point based on profit equation. So it's the same answer you are going to get to, but one is using different method. One is using different method. So I and I, you are going to get the same answer. I and I, you are going to get the same answer. So as I was saying, so break even in units for so let me even delete this one, because this one this equation method, this is its contribution method over here. Good. So I'm good to go. Now IV, if the company sets income target at 30,000, how many units will be sold to make this particular income? So this is where we are going to find the profit level unit. So profit level unit is equal to the fixed cost plus the target profit all over the contribution margin. So fixed cost 48,000 plus target profit 30,000, or is it 3,000? Target profit 3,000, all divided by contribution margin 4. So the answer you are going to get should be something in units. Then let's look at the next one. Determine the city sale that should be made to achieve a target profit of 3,300. So this is profit level sales. They can ask you to use the same information to find the profit level sales. It's just a matter of changing this one to what? 0.33. That's all. Now they have a different profit level sales. So if they want to sell an amount of goods, how much money should they sell? How much should they sell to make that particular profit? So fixed cost plus target profit, all divided by contribution margin ratio. So 48,000 plus 3,300, all divided by 0.333. So you are going to get an answer in CD value. So let me put currency symbol there. Then the next one, okay, this one, that is all the question. Now, there are optional ones that I'll add, where they can ask you to find margin of safety. They can ask you to find the margin of safety, either margin of safety in units or margin of safety in percentage, or margin of safety in sales. Now, margin of safety in units is given by your profit level units minus the break-even units. So your profit level units minus the break-even unit give you your margin of safety in units. They can ask you to find the margin of safety in percentage, which is equal to your margin of safety in units divided by the profit level units. Simple. Or your profit level units minus your break-even in units, all divided by the profit level in units. Then everything multiplied by 100. So you can either do it and get it in 0 points, then convert later into percentage, or you just do it straight away, then by 100. So these are the optional ones I would like to add to it. So under break-even, these are all what you are supposed to know in break-even. And you needed to know it and know it good. Now, after all said and done, if you are able to solve this question, these questions I'm giving you, or those questions over there, you'll be good to go. You can answer anything given to you in the exam because it rhymes true. It rhymes true. But if you are unable to do it, then you go there and then you'll be finding yourself wanting. So kindly go through these questions and then take the following areas too in addition. I always want you to secure yourself for the in case. Now, there is a question in your past questions that I've compiled for you, which, let me see if I can see that particular one and I can speak to it very well. Now, that particular question is a table that involves the very cold, average, and then hot. I don't know if you have that particular one over there. Now, that question can be put in a different format, or it can be put in a different way. The same question, but one is asking you to do something else. The other one is asking you to do something else. Look at the first question. The table below contains information on returns on two stocks. The expected return on the two stocks are, so you have the 7 and 9. In fact, this question is in your handout. It is lifted from your handout. And the question is, you have to determine whether the returns on these two investments move together or not. Now, the very first thing you are supposed to do is to find covariance. So, if you are unable to find your covariance, you'll be found wanting. If you don't know how to find covariance, you'll be found wanting. Let me see if I'll see it. So you were asked, it is somewhere in the initial pages. Yeah, this question. And then you were asked to determine whether the investments move together or not. This is the solution you are going to provide for that particular question. You find the covariance. You find the covariance. So in an attempt to find the covariance, how do we then find the covariance? Covariance is giving us the probability, bracket open, the expected return for investment 1 minus its possible return or its required return. Now, the expected return for investment 1 they gave you was how much? 7%. And the expected return they give you for investment 2 is how much? 9%. The required returns are the 15, 5, and negative 15, negative 5, 10, 30 you are seeing here. The required return for investment 2 is the 35, 15, 5, and negative 5 you are seeing here. So when you pick the probability for 1, you do for 1 horizontal finish, then go to the next one. So negative 0.1, negative 0.15 minus its expected return, 7. Multiply by the 35 you are seeing here, minus its own 9. So if you are going this minus expected, you go this minus expected. If you are going this minus expected, go this minus expected. Don't go and do expected minus this and then mix it. You go in systematic. So I intentionally did it here and I highlighted it. So any highlighted color here represents 1. Any highlighted color here represents another 1. This is how we solve for covariance. So when you finish, you get an answer of a negative answer. The negative tells you that the investment moved in an opposite direction. When one is rising, one is falling. So you can see that whilst this one is in negative, this one is in positive. Whilst the other one is in negative, this one is in positive. So whilst this one is rising, this one is falling. Whilst it is rising from here, this one is also falling. So the negative here is very, very crucial, telling you the investment, they move in an inverse or in an opposite direction. So this is just the answer you need for the question. But how will you then say that this is the answer? Is by solving it. Somebody can look at the table and say, yes, they move in an opposite direction, which is true. But what is the fact and figures? Like Baumia will tell you, we are dealing with data. What data tells you that they are really moving in an opposite direction? Because just in the table doesn't speak it all. So that is what I want you to know. So the question says, determine whether the returns on these two investments move together or not. So it's the calculation you do to score your 4 marks. Then it said, what kind of co-movement? So that's the explanation. They move in an opposite direction. They move in an opposite direction. Or you have been given their returns. You have been given their possible returns. So if you like, you can find the standard deviation. That one there, it is your own cup of tea. So you will go through the hassle of finding your standalone standard deviation and you get the same answer. So that is the first question. This same table is there again. The table below contains information on returns on two stocks. Determine the individual investment expected return. What are the investment specific risks? And which of the two investment is riskier? So that's what I'm saying. You can find it and find the risk. Then you used to find the standard covariance if you want to go through that long process. But this is a question on its own that is asking you specific questions. So if you have the past question, you might have known what I'm talking about. So if you are having the past question, the question is asking you to find the expected return. So you find your expected return, and this is how you find your expected return. This is the expected return for that question. So the let me see this one. Yeah, this is it. This is the expected return for that question. Example 2. It's in your handout, so I'm not wasting my time. So this is it. This is the solution for the determine the individual investment expected return. So it's a 0.1 by -15, 0.3 by -5, 0.4 by 10, 0.2 by 30. Give you one expected return. 0.1 by 35, 0.3 by 15, 0.4 by 5, 0.2 by -5. Give you another expected return, then 9 over here. Then they said the investment risk. So what are the investment specific risk? So standard deviation. So the investment specific risk, we've already computed the expected return. So this is how you compute the risk. You also go and look at the formula and put the formula down. Probability, the expected return minus the required return. This one is minus, that's why it is plus here. This one is minus, that's why it is plus here. And you should know when you are solving for standalone and when you are solving for portfolio. When you are solving for portfolio, it is equal to the probability multiplied by the standard deviation, all squared. This one, it is the probability expected return minus required return, all squared. This is raised to the power 2. Sorry, because I inserted the formula, I cannot raise to the power over here. So these ones are raised to the power 2. These ones are raised to the power 2. But this one here too is also raised to the power 2. Standalone, we don't have anything like covariance inside. So you find variance and then you go your way. So this is how you find the standard deviation for this particular illustration. That notwithstanding, a lot of students also get confused when they get to standalone and then portfolio. Now, I'm going to give you the trick to just pass your exams. Now, trick number 1. You go into the exams that I am going to solve break even. Ask optional question 1. So in the optional question, break even, comp. So session B, you have got to, out of the 4 questions, you've got 1 to answer. That one, they know sure banker, it is coming. So 15 marks in your bag or 10 marks there. You are already prepared for it. Number 2, you go in and solve questions like this. Questions like this. Portfolio. So you go in with point 2. Make sure you understand how to solve questions on portfolio. So questions like this. This question, this type of question. sure banker should be able to know how to handle it, left, right, and center. So that is number 2. Then number 3, how to find covariance given expected return and risk. We simple 4 marks. So just imagine break even 10 marks or 15 marks. Let me say 10 marks, 4 marks here. You've scored another 5 marks here. You are going on. Then you are going with the concept of also number 3, return. If you've been asked to find the holding period return, annualized holding period return, and then total return, dividend yield, and then capital gain yield, all those ones, scoring the 1 marks over there. And then this another portfolio. That's why I say master yourself in the portfolio. This one, they gave you the investment, you find the weight. For the first one, they've given you the weight, 30% here, so you know 70% is in the other. So you go in to solve questions too like this. Master, you are good to go. Then questions like this, these ones, 1 mark, you score it and then you are going your way. There is no way you should score B in business finance. When you score B in business finance, know that you didn't even do well, you didn't prepare well. You should get at least B+, A+. These are subjects you can easily score and shoot your grade up. Computerized accounting, easily score and shoot your grade up. So please, then the theories I gave you. So if you are going in with the exams with 4 plan, break even number 1, portfolio number 2, returns number 3, theory number 4. Any other thing that they will bring, don't answer and wake up. You have passed. So I wish you all the best. You go through the questions and go through the solutions very well, so that you'll be able to answer very well. You have a good night. And make sure, if you don't subscribe to the channel, kindly subscribe to the channel, so that anytime I post the videos, you will have the first hand of seeing it, because some of the videos comes very late. And if you don't subscribe, when you go there, you won't see it early. And by the time you say, oh, now I didn't know how. I saw that the accounting theory, people later on came and see it, and well, time is far gone. So, Charlie, I wish you all the best.